Welcome to another Mr. James accounting tutorial. This time we are looking at accounting unit 1 of HIP, and I'll be doing the entire series of past paper from 2013 right down to 2019, and there was no paper in 2020. Subscribe, like, comment. We have before us trial balance. The unadjusted trial balance was taken from the books of Keymark Limited, a medium-sized store located in downtown Montego Bay. Notice the three lines for the headings. Before you jump into what is required, you should look at the time trial balance carefully. Make sure that it is balanced and the items are in the correct columns. Sometimes the examiner likes to put them in the wrong column and then expect you to correct it before you give the answer. Now, what is noticeable about this and what is concerned about us? We have three items here. First, we have this thing called organization course here that most Unit 1 students have never come across yet. They refer to startup course, and the normal accounting treatment for them is to transfer it to the profit and loss account. Uh, there are two ways of transferring it to the profit and loss account. You can either do so the whole amount, transfer it in the first year, or you transfer it bit by bit every year. And we are not given any instructions as to what to do with it. So what we will do is transfer the whole balance to the profit and loss account in this our year here. The next item is the note payable. If you notice, they do not have a percentage given here, and none is given either in the additional note, so you don't know what to do with it, whether to calculate interest, how much interest, or whatever. And the final item is freight in, a name that for an account that most CSEC student or POE would come across as carriage inwards. Okay. First, we read what is required of. A multiple step income statement of comprehensive income in good form, vertical, according to IAS 1, Section 3 of IFRS for SMEs, and Part 2, a statement of retained earnings. Okay, now we can go through the additional notes, and we have to make these adjustments to the accounts or to the trial balance before we can write up the income statement. Now, we have to do the workings first before we jump into the writing out the answer. If we do not do the workings first and we start writing up the answer, we are going to write up an incorrect answer. There's no doubt about that. So it doesn't matter if you spend about 15-20 minutes writing up the workings and doing the workings. Writing up the answer after that is going to take you less than the other 25 minutes or so that you have. Okay? In fact, you might be able to finish it in less than 10 minutes. So the first item we have here is the merchandise inventory, and we don't have to do any workings on that. The figure is given to us. Next, we have the depreciation on the equipment is charged at a rate of 10% on cost. So we head up workings on our page and depreciation. The cost of the thing from the trial balance is 170 to 40, and it's 10% on cost, so it's just 10% by the cost. I will get 17,024. Next, we have the insurance expired during the year amounted to 1320. So that is going to be the amount for insurance. Normally we transfer the expired portion to the profit and loss account. It was discovered at the end of year two, at the end of the year, that a total of 50,000 of the accounts receivable was uncollectible. Uncollectible is the American terminology for bad debt, sometimes used in the international scene as well. Okay, so 50,000 is bad, and you gotta write it off as bad. So bad debt 50,000. We are not going to do the balance sheet section, so we don't need to minus it from accounts receivable. All they ask us for is a statement of comprehensive income. Okay, bad debt expense, and this here is another error again. It should be provision for bad debts is estimated at 2% of accounts receivable. Okay, so provision for bad debts would be 2% of the account receivable in the trial balance is given as 3,300,050, and that would be equal to 6,001. We want to bring our bad debts provision up to this amount. So we already have 4,482 in the trial balance. So we need to put in only 1519. So our increase in provision for bad debts would be 1519. Correct. And here's one of those items that uh, something the percentage is missing, so we cannot calculate the interest on the note payable that is due during the year. This note is more pertaining to the balance sheet. Corporation tax is to be charged at 3.3%. Okay, when we calculate the profit, we will work out to the 3.3% as tax. The bond payable attract an interest of 10% per annum, and it's paid semi-annually. What you need for your income statement is 1 year's charge. So we have the corporation tax will be calculated when you have calculated the profit. Okay, so the bond payable attract an interest rate of 10% per annum. Bond interest equal 102,600 from the trial balance multiplied by 10%. What you want is 1 year's charge in the income statement. Then we have the dividends. The preferred dividend is 8% by 120,000, and that is equal to 9,600. Ordinary dividend, we have some workings to do. Take the amount in the trial balance and divide it by the amount per share, $20. We'll get 15,000 shares. It's $2 per share. So 15,000 by 2 gives us $30,000 ordinary dividend. And we have completed all our workings there. So coming up next, preparing the income statement. We begin to write up our income statement, and we begin with the sales, and from that we will list the sales, returns, and allowances. At CSEC level, we know this as sales returns, but if you're doing a income statement according to the IAS, you need to take off all the allowances as well. Allowances are for bad debt, provision for bad debts, and then there is discounts allowed as well. And we don't have any discounts allowed in this question. Okay, so the provision for bad debts and the bad debts comes out of the sales to get the net sales. From that, we less the cost of sales. We start with the inventory, and we have the purchases, and we do with the purchases similar to what we did with the sales. We take off the discounts received and they add on the carriage inwards. Okay, if there's any returns itself, we will also take off that. And we get the net purchases here. Add that to the cost of sales, sorry, to the opening inventory, and we get this figure here. From that, we minus the closing inventory, and we get the cost of sales. Take the cost of sales from the net sales, and we get our gross operating income. Okay, so this income is only from operations, from trading, right? Now, the question asks for multiple step, right? That's why we have to show all these details. Another way of doing it, we could have done this section, the cost of sales, in our workings, and take this figure here and minus it from the net sales and get gross operating income. We would still be doing a multiple step income statement. Subscribe, like, comment. Here we have a gross operating income from the previous section of 634,201, and then we have the operating expenses. These are all the expenses from the trial balance that did not need any changing at first. We put them in first, and then we have our depreciation on equipment and our insurance of 13,000, right? These are from our workings, giving us total operating expenses of 612,084. We take away that from the gross operating income and we get the net operating income. Then we have some other income of 3,710. You can see the figure in the trial balance again. Net income. After you take the 3,710 from the operating income, you get your net income. From that, you have to take off your financial expenses, which is the bond interest. We don't have any other loan interest. We didn't have a figure for the note payable, remember that? But we have the organization cost amortized. Since this is a intangible asset, what we do is we amortize it. We cannot depreciate it. Okay. We add these two together, we get 20,260, and we take that from our net income, and we get the net income before tax of 5,567. One third or 3/3% of that is 1856. We minus from the net income, and we will get a net income after tax. Up next, we will look at the entire income statement. We're looking at the entire income statement now. We must make sure that we have the headings in 3 lines. We must answer the question who, what, when. Whose income statement it is? Kmart Limited. What statement it is? The income statement. And when? For the year ended 31st December. We must make sure Also, the sales and returns and allowances comes out of the sales, does not come out of any other figure. Similarly, for the purchases, the returns and the discounts and the freight must be added on or minus from the purchases. We cannot take them from the opening stock. And we get the net purchases here. This is added to that. Okay, after we get the operating income, we can add the other income to the operating income as well. That's another option. Okay, the operating expenses, general, selling, and administration, and we have salaries separately, depreciation equipment, and insurance. Okay, those are the operating expenses, the bond interest, and the amortization of the organization costs comes in the financial section, and after that we get our net income before tax. We have to minus the 1/3 of tax from, and then we get 3,711 as our net income after tax. Now you can take this as a format for the IAS. There are many formats in the IAS itself. This is a simple format for multiple steps, and you can use this. Next, we have Part B, KMAT Limited Statement of Retained Earnings. Notice again, it's a statement of retained earnings, not a statement of equity. Retained earnings is one account only in the equity, and it is at a particular date. Okay, we start with the balance from the trial balance of 110,000. We add the net income for the year, and we get 3,711 and 13,711. From that, we minus the items that would cause the account to decrease: the preference dividend, 9,600, and the ordinary dividend, which we calculated in the workings. And we will get a balance at the end of the year of 74,111. Notice all we have to do with the statement of retained earnings is we have to add on those items that cause the account to increase and minus those items that cause the account to decrease. So, and we'll get a balance at the end of the year. It works just like any other account. And uh, sometimes you have other items like transfer to reserves and so on that causes the account to decrease, and there may be other items that cause it to increase. But usually, the only item that causes it to increase is the net income for the year. Subscribe, like, comment. Three friends, Kari, Kwabi, and Kofi, form a partnership to operate a nightclub. Seventh Heaven, with Kari investing 200,000, Kwame 160,000, and Kofi 100,000. They agree to share the net income as follows: salary allowances 160,000 to Kari, 100,000 to Kwame, and 100,000 to Kofi. Interest allowances 12% on opening capital account balances of each partner. Any partnership income in excess of the amount required to cover the interest and salaries is to be divided 60% to Kari, 20% to Kwame, and 20% to Kofi. The partnership income for the first year of operations ended 31st December 2012 amounted to 741,000. Show how the income of 741,000 would be divided among the three partners. Show clearly the amount of interest, salaries, and the residual amount divided. 17 mark. We part C, the answer. We could do the answer in three columns like this, one for Kari, one for Kwame, and one for Kofi. And at a total column here that controls it to tell us what it balances back to the 741,000. So first we will give them their salary, 160,000, 100,000, and 100,000, giving us a total of $360,000. Then we give them the interest on capital. Womi, sorry, Kari would be 12% of 200,000, which would be 24,000. Kwame, 19,200, and Kofi, 12,000, and we get a total of 55,200. When we add those on and add the gross, we come up to 415,000. Okay, which leaves 325 again, and the profit to be shared among them in the ratios. When we share it in the ratio, Kari will get 195, 480, Kwame 65, 160, and 65, 160. Notice here that the amount we are sharing is 325, 800, not the entire thing here. Okay, it's the amount remaining after we have given them interest and salary to the total of 415,200.